Right, good morning to everyone who is following us today online, and welcome to panel discussion number 2, where we are going to have our conversation today about what the mining industry looks like in a post-COVID world, and what that actually means for investment in the mining industry, not just for shareholders, although we are joined today by quite a few, sort of panelists who keep their eye on the market, but also by stakeholders and the broader stakeholder group in the mining industry, and what it means for all of us to move out of COVID, hopefully not back to normal, but potentially back to better than where we were before COVID started impacting all of us. So our first question this morning is going to go to Bruce Williamson, who is a mining analyst at Integral Asset Management. And Bruce is one of those people who, in old school fashion, walk the long road. He started his working life as Goldfields, as a learner official. He qualified at WITS, but also spent some time getting a BCom at UCT, before ultimately joining the stock market fraternity, Bruce, back in 1981, right? Almost in the days of the international gold standard still. But Bruce has spent more than 25 years now in Cape Town, far away from the coalface of the mining industry, if we can be allowed that pun. Working as an analyst, including at Imara Africa Mining Fund. So Bruce, before we start talking about the post-COVID recovery, and I know we can have an argument about whether we actually are post-COVID yet, or whether we are still, very much in the throes of the pandemic, but maybe you can just start with sort of a general operational overview. What happened to mining companies as COVID hit? What have been the impacts on mining companies operationally, financially, and how have they done in terms of coming through the pandemic?
Well, good day, Sandra. Good day to the rest of the panelists and to the audience. Thank you for giving me the opportunity to join you. I think what we've got to recognize, and we need to go back to 2014, 2016, the end of the last downturn, which was pretty brutal. And after years of analysts and fund managers calling for growth, mining companies got themselves into a lot of trouble. And I think they've spent the last few years consolidating their balance sheet, focusing on the existing mine infrastructure, reserves and resources. And many of them are now in pretty good shape. So I don't think they want to go back into that dark space of just going for growth all the time. So with that in mind, we were not sitting on excess capacity when COVID hit. So COVID has had two impacts. One is directly on production, and that is dependent on individual governments and how hard the lockdown regulations were. Whether miners had, whether their workforce was locally based or fly-in, fly-out basis, how they handled that process. And then the second impact has been the supply chain, is all your materials and your procurement of goods coming into the mine have been greatly disrupted. And so there is no single answer here. Everyone has got a good or bad story to tell. But I must say, broadly, the miners have coped just because they are used to coping with things going wrong every single day. That's the nature of the beast. They've actually done incredibly well. But remember that most do not have any excess capacity because of the lessons learned a couple of years ago. And so the big issue, and it doesn't only affect mining, is that the previously well-synchronized logistical processes have been very, very disrupted. And miners, of course, rely on exporting all their product out, and the bulk suppliers have got rail and shipping, ports, issues to handle. So everyone's got a different story to tell. And by and large, you're seeing these shortages happening. Of course, we've had a lot of extreme weather that's also impacted the flow of commodities.
Thank you, Bruce. Yes, it's interesting with the mining industry. There's always a debate with shareholders and investors to say, when the prices are running, are we there? Do we have the opportunity to take advantage of those prices? And I suppose the big challenge for us coming out of an episode like this, where we actually have seen some strong commodity prices in the market, is the question as to whether or not mining companies really have been positioned to take real advantage of that commodity pricing looking a little bit stronger. So with that, I'm going to go to our next panelist, Mark Williams. Mark is a director at Charteris Treasury. He graduated from the university in Surrey and has 15 years experience in investment management, principally at his current home firm. And before that, he was a part of or during his tenure there, he's been part of the Gold and Precious Metals Fund since its inception in 2010. So, Mark, have we seen shareholders and the stock market responding equally positively to this? Or have they also been worried about the mining industry?
Thank you. I'd like to echo Bruce's comments and say that, hello to all, and hello to my fellow panelists. There was things that Bruce said there that I would like to comment on. So some of the things he said was absolutely correct. So in our business of investment management, we were meeting a lot of these management organisations of these gold and silver mining companies when they came to see us, and in throughout 2012, 2013, 2014, they were telling us of how much pressure that they were being under by institutional investors. Oh, you've got to do capex. You've got to do capex. It was the only thing that was on their mind was capital expenditure, and a lot of these mining companies got into huge problems with their fundamentals. And when the fundamental analysis was coming through from an institutional side, people were looking at these mining companies go, they've spent so much that they're no longer, they're in serious trouble here of being in financial ruin. These cycles that they would then repeat themselves. So in around mid 2014, there was this sort of incentive by a lot of mining companies go, we need to get back to basics here. We need to start looking at these fundamentals and getting these costs properly back under control. So a lot of the management that was spending money like confetti, those management personnel, they moved on. They were moved on, and new blood came in, and their number one option on their to-do list was get the costs in control, get them back under control. So you've got the situation where, okay, I'm the new management director or new CEO. What is the number one thing that I can't do that my predecessor did? Right, spend money like confetti. Okay, let's get the costs back in control. So there was this huge wave of incentivizing by mining companies to get these costs under control and to make them fundamentally sound again, so that they could then form a base of going to institutions and say, okay, we've learned our lesson. We're no longer doing capital expenditure. We're going back to fundamentals. We're going back to basics. We want to be a company where people don't look at us as just a mining company. They look at us as, are we a good, pragmatic, financially sound business that people can invest in? And that has proved to be very, very sensible to do, because we saw the low really around sort of October, November 2015. That was when sort of the prices started to bottom out a bit. And since then, you've seen mining companies go up and up and up. Even though most institutions would have avoided mining companies for the first 2-3 years of that run, because their track record isn't very good, they waste money, etc., etc. but they've worked on their fundamentals. They've done such good work that they're now so attractive to investors. I mean, you wanted a bit of stock market analysis. So we were looking at, so being based in London, which is where our main index, the FTSE 100, has a huge weight towards the mining sector. So we're looking at, say, Antofagasta, Rio Tinto, and Anglo American. So over the last 5 years, if you'd invested in Antofagasta or Rio, you would have made over 200%. That's just in capital gain. That's separate from the dividends that you've been receiving over that time as well. So you're in this sort of double bubble scenario where you're getting wonderful capital gain, but you're also getting very high levels of dividend income, which if you're an income investor is very attractive. You're not getting 6, 7, 8% yield at the bank. So, you know, some parts of the world it's either zero or even negative. So that is very attractive. But going back to Anglo American, of course, everybody knows that they've got many projects across Africa. If you'd invested in Anglo American 5 years ago, you'd be up over 300%. And both Anglo American and Rio, they're paying 6% yield at the moment. And Rio came out a couple of weeks ago saying, we're very comfortable paying this level, and we're going to continue doing so for the next couple of years. Because we did all that work in 2014, 2015, 2016 to get our balance sheets in order, we are now in such a good financial sound position that we can watch the commodity prices go up, we can continue operating. We've got so much cash in the bank that we now can go to investors, whether they're institutional, retail, whatever, and say, we've done all this work, we want to reward you. This is the good work that we've done. We want to reward, we want to entice investors into our company. So we are financially sound. We have a 5-year track record now of capital gain. We've got this dividend income payment plan that's very attractive. So the mining sector can showcase some very attractive features that investors will have to take notice of, in my view.
No, Mark, I absolutely agree. You know, I think you've given some interesting statistics there around investing in Rio Tinto and Anglo American. And I heard one market analyst refer to Kumba Iron Ore, which is, of course, is a major Anglo American subsidiary, as a 10-bagger. So literally saying that if you had invested in Kumba coming through this period that you and Bruce have both, you know, sort of been describing from 2014 through to 2016, and you'd stayed invested in Kumba, you would have made 10 times money on that off the back of the iron ore price. And I think certainly in the South African market, in Johannesburg, where I've been based, I think the windfall taxes or the tax contribution that's been paid by mining companies into the South African fiscus has come as a great relief at a time when other parts of our economy has been struggling. And it's actually enabling the South African government to really put some real cash into our country's post-COVID support efforts. And so I suppose that's a good time to ring in Olebogeng Sentsho, our third panelist. Now, Olebogeng is a mineral economist, and she's an entrepreneur with interests in both mining and energy. She is the finance champion on the Minister of Mineral Resources Technical Secretariat for the evolution of funding models for junior miners in South Africa. She's also a recipient of the inaugural Outstanding Women in Mining Award in 2016. And to prove that she is still very much younger than Bruce, Mark, and myself, she's also one of the Mail and Guardian's top 200 young South Africans in 2020. So Olebogeng, great to have you on the panel today.
Thank you.
If we say that actually the mining industry has come through this period reasonably well, because as Bruce and Mark have pointed out, the balance sheets have been prepared. They were, you know, able to weather a storm much better than maybe previously would have been able to weather it. and they've got the tailwinds from the commodity prices. What is it, do you think, as a starting point, that mining can do? Why is it an important sector for us post-COVID as we're coming out of this period?
Good morning, everybody, and good morning to my fellow panelists. You know what? I think that it's very, very important that we understand the role of mining in the global economy as a whole. Mining is a catalyst for economic growth and development. And if we nurture mining, economies grow, economies develop, human capital develops. And that is where I think we need to focus our energies when we talk about mining. It's all good and well to look at the numbers and to look at how well we can often do in terms of the balance sheets that mines have and the dividends that mines pay out. But we have to understand that for the host communities and for the countries that find themselves hosting mining companies, mines provide a great deal of catalytic activity for economic growth and development. And we always have to be cognizant of the fact that mining is paramount when economies are growing and developing, and we have to nurture mining and ensure that whatever we do in terms of the extractives as a whole, not even just mining, whether it's mining, oil and gas, we emphasize the point that these are catalytic industries for economic growth and development. Looking at the COVID situation, I think has actually demonstrated to us the importance of mining, more so because a lot of, when different countries went through their different lockdowns at the times that they went through them, some mining companies actually started doing a lot better. Not because everybody was stuck for commodities, but because they found a way to exercise their counter-cyclical measures. This was a direct result of the downturns that we've had in previous years, where they've said, you know what, we can't be spending money like it's confetti. We have to exercise our counter-cyclical measures, and we have to make sure that we implement them such that should there be a global catastrophe, which there was, we are then able to say we can operate at the bare minimum. And in fact, not only can we operate at the bare minimum, we can excel at the bare minimum. You look at a company like Kalahari, which was 7 billion rands in debt. Kalahari removed almost half the machinery from their underground mines and reported the highest numbers they ever have, simply because they implemented their counter-cyclical measures. They implemented their austerity measures, and they started watching what was leaving their pockets. And for me, when you look at the broader picture of where mining fits into the world in a global pandemic, it's a place to start over. It's the perfect place to start over because, like I said, it's catalytic. It's catalytic and it starts economies. And if we want our economies to grow and develop, we have to start with mining. We have to start in a place where we know this then creates those linkages that will enable our economies to grow and develop. So for me, I think definitely, you know what, in times like these, we have to look at mining as a priority, in fact.
Olebogeng, something that you, I think, hinted at very strongly, but didn't actually come out and say in the conversation was that this is probably something that requires much closer cooperation, also between mining companies and their host governments, as much Absolutely. As it is around host communities.
Yeah, that's something that I actually wanted to mention. And then I think I got so involved in my economic growth and development because that's what I love. But the wonderful thing about the South African government is that it's learning its place in the global economy and in the global world as a player in the mining space. And it's trying to find its footing, and it's trying to find ways to balance both investor interests and host community interests. ESG is a very important factor in how South Africa nurtures the mining industry. And it treads a very, very, very delicate balance in trying to accommodate investors and their host communities. And what our government is doing in South Africa at the moment is that it's trying to find ways to mobilize places where funds are available and had been ring-fenced for other things, to say, why don't we utilize these funds in order to capitalize small-scale and emerging mining projects? these are not difficult to finance, especially if you've got a bank guaranteed grant that you can shop around to the global capital markets and say, look, my country believes in my project. Will you believe in my project? And those are some of the things that we're working on with the Technical Secretariat. The Technical Secretariat and the Industrial Development Corporation are working very, very closely to ensure that whatever funding models come out of the discussions that we are having, not only demonstrate to the global economy that we have faith in our mining economy, but they also demonstrate that there are other ways to fund mining projects and to develop that strong industrial complex of mining from within our own resources without having to constantly knock on other people's doors. A comment was made at PDAC, I think about 2 years ago, where someone said, how do we invest in South Africa when South Africa won't even invest in itself? And these are some of the things we're trying to remedy. If you can demonstrate a strong commitment to your own mining industry, you give signals to the rest of the world to do the same. And unfortunately, because we've had such, it's been a revolving door of ministers. Once that revolving door of ministers has now been stabilized, we will then start to develop policy and develop systems and programs that will propel our industry forward without necessarily requiring the greater global community to come with their pennies and pence. You know what I mean?
Olebogeng, thank you so much. And I think we have to give this to Mark for having coined the phrase of the day, which is spending money like confetti. But Bruce, I want to come to you, because I think we're mindful of this being the Africa Mining Summit. And so, sort of a much broader conversation around the continent and sort of all of the countries in the region. And I want you to maybe expand a bit on this idea that Olebogeng has raised in the conversation, namely, finding our way between the mining industry, private sector and governments, and closer collaboration. And really understand, what your views are on how this is something that can actually be used to the mutual benefit of the parties to drive the mining industry forward.
Yeah, Sandra, hi. Well, just to go back to your comments about Kumba, that was not a 10-bagger. It was a plus 20-bagger, over 2,000%.
Wow.
And the interim dividend now is 73 Rand on a 600 Rand share. There's an interim 12% coming into your pocket. Or I think it's out, it's already. Okay, so yeah, those cash flows are just phenomenal.
I stand very happily corrected, although I'm not a Kumba shareholder.
Well, let me tell you that the big 7 unit trust resource funds in South Africa, from what I've looked at, not one of them held Kumba. Wow.
Wow. Okay, let's get ourselves back.
Yeah. All right. So, I mean, exactly, to the point that Olebogeng is making, I just want to remind the audience, and I don't want to be a history teacher, late 70s, early 80s, South Africa had this about the 8th biggest stock market in the world. I mean, it's almost, you have to wonder, how did that happen? It was all because of mining. Yes, we were blessed with the Wits gold system, the Bushveld igneous complex, etc. But we did an incredible of using that, and mining. The mining multiplier is the greatest creator of jobs and businesses down the line. Johannesburg is not here by accident. Biggest city in the world, not on water. And people are still flocking in here. Okay, so mining is a tremendous multiplier. Now, my time in running the Imara African Resource Fund, and that took me to looking at companies, listed company. We had about 3 or 4 unlisted, but mainly listed companies. Mauritania, Egypt, Ghana, Tanzania, Mozambique, Eritrea, Zimbabwe, Zambia. Namibia, Botswana, and a bit of SA, is the common thread is what governments want and how they think taking something out of the ground and where the benefit and where the added value goes to. If they think it's just for putting it into a community that lives nearby, you know, we get lost in ideology here. And so really, I think it's time for hard talk around ideology and what the end goals are. Now, all I can say is that my time in 50 years of looking at the mining industry and being involved is if we get our policy right, money is not the problem. You have to have an adequate return, and you need policy that is going to bring those investors in. And yeah, we need hard chats between government, private sector, the community, citizens. This is a merry-go-round, and it can keep on going round and round and round and round and helping to grow the economy. You're not going to get a bunch of lawyers and accountants doing so much work that employs the population. Never going to happen. So why don't we use mining and farming? But we need the right policy.
Bruce, as a former lawyer who now works for EY, I'm going to try not to be hurt by your comments on lawyers and accountants. But Mark, I actually want to come to you because there's a theme coming through what Bruce and Olebogeng are kind of talking about. And it goes to the impact of mining on our broader society. It goes to the way that stakeholders view the mining industry. And you volunteered this, right? Why do millennial investors then still take such a dim view of the mining industry? And why are we so unpopular with it?
Well, it's a very simple question, but it has a very long, complicated answer. I mean, the millennials tend to look at the mining sector only in the negative. They only look at it as, oh, you're destroying the planet, you're drilling, you're using chemicals, and everything's bad associated with mining. Maybe they ignore it on purpose, or maybe they don't ignore it on purpose. But there are many good things that a lot of these mining management companies are doing, especially with their local communities. They're engaging their local communities. The well-being of their workforce is of paramount importance, and always has been paramount importance. But we're post-COVID, it's taken that care of the local communities to another level. So whether it's helping local communities with supplies of food or sanitation or whatever it happens to be, but there's a lot of good work that the individual people are doing, both people in the boards and people who are working as part of the workforce. So it's person to person as opposed to organisation dictating to a community, which is a message that needs to get out more from the mining from mining companies, is that we're no longer this sort of it's us and them. It's much more of a we are united, we are together, we're working in harmony. And that's a very powerful message to get out in any sector, not just the mining sector. But if this brand association with mining is so negative, that would be a very powerful first step to helping change perception. But also millennials are maybe not looking at the broader picture in terms of, well, what products are they consuming? So that a lot of millennials are demanding a few things that they have on how to change the world. So, okay, so what do they want? Okay, so they want people to stop driving petrol-powered cars and they want them to drive electric vehicles. Okay, well, an electric vehicle takes 4 times more copper to use than a petrol-powered alternative. So where does that copper come from? And then you've got all that. That's, you know, you're looking at the engine, you're looking at the batteries, you're looking at all of the other components that are inside the car. So they're all going to need aluminium, they're all going to need zinc, they're all going to need silver, they're all going to, you know, so there's this where, you know, these products are going to be used. And all millennials also, you know, they don't go anywhere without a mobile phone. They have a computer or a laptop or a tablet. All that circuitry requires aluminium and silver and copper wiring and everything else that goes with it. So there are products that are necessary in terms of the millennial outlook. Oh, we need this, we need that, we need this. Okay, but look at how those objects have come to be. If you want to spend $1,000 on a new Apple iPhone, you have to understand that inside the circuitry, inside the cameras, inside the everything else that goes with it, there's going to be a lot of raw materials, base metals, and precious metals as well, in order to bring those projects to life.
I think it's Robert Friedland of Ivanhoe who's famous for saying that everything we consume is either mined or farmed in the first instance. And I think that's sort of the point that you're bringing home. So I want us to expand a little bit on one of the first items that you raised. And of course, this is a big thematic coming up in investment in mining. It's something that was already a very hot topic before the advent of COVID. But it's probably fair to say that the impact of COVID has been such that our focus globally across all industries has intensified on this specifically. And that is the question of ESG, the role it plays in investing, I suppose, at one level. And I'm going to ask Bruce about that a little bit later. But I want to go back to Olebogeng and really sort of focus on this notion of ESG. And Olebogeng, how important is this post-COVID? Has it become more important? And what is the imperative for the industry around this at the moment?
You know, I think ESG has never been more important than it is right now. Not just because for the first time people know exactly what ESG stands for, but also because people now have a deeper appreciation of the fact that you are working inside a host community. You are being hosted by that community. You cannot simply go to that community and pillage and then leave and ask the people to be understanding that you had a commercial objective to achieve. ESG is the embodiment of creating value, not just for the investor or the miner, but also for the community. ESG is what makes a mine's life longer. Because when you include the community in the development of that mine, in the protection of that mine, in the commercial viability of that mine, in the production of that mine, you not only have a community that's going to be supportive of all your efforts, but you're also going to have security guards. I'll give you an example. One of the projects that I was working on in Olebogeng is hosted by the Pedi people of Limpopo. And they were very, very clear to say, this is our mine, we're going to protect it because it gives us jobs. As a result, we don't have any security concerns on the mine because they have taken full ownership. They have said, this is something that feeds our children. And when you look at the ramifications of the pandemic and how it is now even more imperative that host communities are included in this, you then start to see that, but ESG is something we can utilize to boost the longevity, not just of the mine itself, but also the linkages associated there too, because then it no longer becomes a situation where mines are being pressured to have these town hall meetings where they say, we need suppliers for coffee, tea, lawn mowing, and cleaning. They then come and say, guys, we have very, very big needs, and we are willing to partner you with some of our bigger suppliers such that there can be a transfer of skills. ESG prioritizes transfer of skills. When you are able to transfer skills from your big suppliers, your big service providers, to the community members. Those community members are then empowered not only to educate their own children and to extricate their children from, most host communities live in abject poverty. They're able to educate their kids, and their kids can then go and study and come back and make their communities better. The very ethos, the very basis of why ESG needs to be a building block of every single mining institution in the world is that it develops human capital. And it develops it in a very, very real way. It develops it in such a way that you cannot extricate the mine and the person who was developed by virtue of the connection of the mine and the community. This is an anecdotal an example, but my husband worked for Anglo American for the longest time. He got his bursary from Anglo American. We grew up in Rustenburg. So not only did he get his bursary from Anglo American, he worked for Anglo American. He became a management accountant at Anglo American and was subsequently headhunted. His life is now 10 times better than it would have been had he not had a mining company that was looking out for the community within which he lived. He is no longer that mine's problem. Anglo-American can now say to him, we've empowered you, live, laugh, have a glass of wine. Those are tentative and intangible examples of how ESG is actually catalytic in empowering people, transferring skills, and ensuring that people no longer depend on mines for jobs, because mining should not be a job creator. Mining should be a catalyst for job creation, because we want to start being industrialists and producing the products that are produced from the minerals that we mine. And this can only be achieved if there is that strong link created by ESG between the host community and the mining house.
Olebogeng, thank you for sharing that personal story. I think it's the kind of thing that really can bring it home for our audience, dialing in today. What a difference mining and the mining industry can make in individual people's lives through their interventions. And so, Bruce, I want to come back to you, because I believe you represent the Investment Analyst Society on SAM codes and SAM ESG committees. And so the question around ESG and sustainability and what it does, should we make more of this? Should this be something that comes through a lot stronger in reporting, in the way we speak to shareholders?
Yeah, absolutely. In a way, I think it's actually very sad when you look at the E, the S, and the G. I mean, if people were just brought up with good, old-fashioned values, cared for everyone, had respect, I just wonder, why do we actually have to legislate all of this? So, but human beings being who we are and what we are, and we're pretty bad people most of the time, we now have to have ESG. And so I've been quite involved. I've sat there passively listening for 2-3 years of this wave of ESG coming, trying to fathom out, is it going to be rules only, guidelines, legislation? How's it going to fit in? And how will we actually account for all of this? And as all I can tell you now, and we had a big day, we had 2 days last week, of ESG presentations, local and foreign contribution. This is huge. It's a massive impact on every one of us, and we better all buy into this. Otherwise, it's not going to work. It's like climate change. We all need to buy in and understand. Now, I think there will be legislation and regulations put into SAM codes. Therefore, it means it will affect the JSE and listed companies. What we don't even understand, we haven't gone to the accountants and saying, well, if we implement XYZ legislation, how are you as the auditors and accountants going to account for it? Because I'm the investor, Mark's an investor. I open up the results and oh my God, what are these adjustments that have gone through the income statement that affect the balance sheet? So we need some very, very serious thought as to what we're going to do. My plea is make it relatively simple. People need, the goodness in people needs to come out, and we don't need to be overburdened with too much regulation. And then there was another point I was thinking of is the cost. What is the cost going to be? Because if these costs build up and they are too prohibitive, it actually impacts the miners' cutoff grades of what grade can I mine to make a profit. So this has got to be properly thought out. These are not millennials sitting in cities because they don't do rural. They haven't got laptops and access. So they sit in cities. They need to understand how difficult it is for miners. Don't overburden with costs. Keep it simple. Understand how we are going to account for it, and understand the impact on the investors' returns.
I can see Olebogeng come off mute there to make a contribution. I'm going to let you, sort of share your thoughts with us, but then I want to go and ask Mark a question about this ESG and investors. Olebogeng?
Sure. I just wanted to just add to what Bruce is saying. That is ESG. And the communities and the mining companies that have mastered that didn't need legislation. They just did it because there was an understanding between the two of them that this is how we're going to work together. And those millennials who are sitting in those air-conditioned offices and saying all these things, I believe in protecting the environment and everything, but Bruce is so right. Unless you understand mining, you have no business trying to impose legislative ESG controls because you don't quite understand the environment you're trying to legislate.
Thanks, Olebogeng. Mark, are shareholders getting this? And are they prepared? To what extent do they factor an ESG rating, for example, or ESG performance into deciding which mining stocks to invest in? Or is it just one-way traffic in the sense that if you don't have a great ESG record, we're not going to invest in you? And if you have a good ESG record, we may invest in you, but your ESG record alone will not make us prefer you over a different stock. How are they factoring this into their investment decisions?
Well, the ESG conversation goes both ways. So investors, maybe younger investors more so than older ones, but the subject of ESG is never off the table from an investor standpoint. But the management companies that we meet are also very prepared for that. They know that ESG question is coming. So they will have various policies that they will want to put forward and say, well, we've done this, we've implemented this policy, we've done this is our record here, et cetera, et cetera. I mean, there are stocks out there that we invest in. So our rating system is the MSCI. So they have an ESG ranking system that goes from CCC, which is the worst, to AAA, which they deem to be the best. And some of the mining companies that we invest in will publicly say, look, we have this high ESG rating. So if I give you an example, Agnico Eagle, a very big gold mining company, has mines all over the world. They have a AA rating, very high. So that's something that they can put forward, they can showcase and say, this isn't an internal report where we fudge the figures a little bit. This is outside independent scrutiny looking, and mining companies will be under more scrutiny than perhaps companies in other sectors. So even more so. So Agnico Eagle have got a AA rating, which is in the top 10 holders of our gold and precious metals fund. Wheaton Precious Metals, again, that's in there as well. That's got a AA rating. Some of the stocks we were talking about earlier, Antofagasta's got a AA rating. So some of these have got some very, very high ESG ratings. So if you are an investor and you're looking for, let's say, an ESG product or an ESG fund, you'll look at your valuation and just see XYZ ESG fund, and you go, oh, okay, I'm thinking about I'm an ESG investor and I have exposure to an ESG portfolio, but they don't necessarily look at the underlying holdings. If they were to review the underlying holdings that some of the institutions have inserted into that portfolio, they would say, oh, hang on, it's full of, why are mining companies in there? But surely they can't be ESG compliant. But when you have this outside assessment of whether it's Rio, whether it's Antofagasta, whether it's, you know, whatever mining company you like, they're under scrutiny, and that's under constant review as well. They can't just put out an ESG rating in sort of Q4 of 2019 and then rest on their laurels for the next 3 years. They're always going to be under scrutiny. That question, whether it's quarterly reviews, whether it's half-yearly production numbers, that this topic is always going to be a factor. Go back to Anglo-American, we talked about that earlier. That's just been raised from I think BBB to an A rating recently. So they're able to show evidence and showcase and say, you know, okay, we've taken this advice on board, that maybe we weren't strong enough in certain areas, whether it be toxic waste, corporate governance, whatever it happens to be. But now we've implemented X policy, Y policy, we've done this report, and we can showcase that we are now improving. We are now A rated on an ESG. So we are ESG compliant. We can be included in some of these model portfolios, whether they're ESG or just regular portfolios, whether it's for funds like ours or other funds that institutions create. So that message will get out there, that this independent assessment of these ESG rates, they're going to come. They'll be more standardized. Mining companies will be a lot more willing to put that out front and center and say, you're interested in mining, you're interested in this company, why should I be? Oh, well, we've got an ESG, we've got a very high ESG ranking. We pay 6% yield. We have got very good fundamentals. We, you know, et cetera, et cetera. It will become part of the sales pitch to entice additional investors to their share register, but it will also give reassurance to those existing shareholders who have maybe held the stock 6, 12, 18 months, whatever it is, that the company is continuing to evolve, that the company is continuing to progress, and that would be positive for all.
So Mark and the panel, you know, I'm mindful of the fact that we sort of have 10 minutes left or so in our allotted time slot, and there are still sort of two points coming out of this conversation that I want to pick up on. And Bruce, I'm going to ask the first one to you, and it goes along. It speaks to something that Mark's been talking about, which is, you know, investors sort of being surprised when they find mining companies with strong ESG ratings inside ESG investment portfolios. And actually, one of the best rated South African mining companies from an ESG ratings perspective, most highly rated ones, is Exxaro Resources, which is a coal mining company, which is, you know, sort of looking to transition and see how it deals with the fact that it's a coal mining company. But I think, Bruce, the question here for us also is, when we take a look at this process that mining companies are going through of transitioning into a low carbon economy, what lies ahead for mining companies in terms of that transition to a lower carbon economy? And what should we be expecting to see?
Yeah, okay. I mean, Sandra, it's as I said earlier on, this is extremely complex. It involves people, the planet, and profits, and this is going to unfold over decades. Anyone who thinks you can turn on, turn off, it's not going to happen. And as I said before, it requires all citizens to take an active part here and play their role to make this happen. So, you know, it's interesting, just adding to picking up on some of the comments Mark was making, is, you've got people like the MSCI that have come up with a rating. Now, when I sit in these committee meetings and the actual, where the skills are across all the different disciplines within mining, these people are questioning themselves as to who has the skill to actually decide on which regulations are applicable and where you stop and start. Meantime, we've got outsiders who have already set up their tick box list. So, I think be careful of putting the cart before the horse. So when the practitioners that have these skills are now trying to work out who is competent enough now to actually sign that ESG report off, they don't even know themselves. So that's how early this is. So legislators need to make that connection between whatever they're going to rule and the impact it has down on the mine and its profitability. The other point is that this is very, very easy for it to be hijacked by big miners and big asset managers that have the money to create ESG departments. They raise the bar so high that smaller miners have no chance. They can't fund it. Smaller asset managers don't have teams of people to go and check on all this ESG. So we've got to make sure that the.
Sorry, I think we're just losing Bruce as a result of a poor connection. I think the flip side that we've also seen to the ESG conversation and the ESG ratings process, just while we give Bruce an opportunity to dial in again, and I think the audience can see me trying to squirm out of the morning sun here in the corner as well, is we have, of course, seen banks and financing institutions step up into the ESG space and really try to make a difference and encourage their borrowers to perform better on an ESG basis. We've seen, and one would hate to mention, kind of only some of them on a platform like the Africa Mining Summit. But we have seen banks like Standard Bank and Nedbank and a few others come out with funding products that actually encourage clients towards improving their ratings, ESG ratings. And we've also seen quite a few of these funders in the market come out with green financing projects or green financing products that are intended to encourage mining companies and other customers to improve their green performance. And so Olebogeng, I think another point, that Bruce had been making was to say, is a lot of this designed for the large companies? Is there space in this for the smaller players? And so from a funding perspective, where do you think mining companies and maybe specifically junior miners find themselves in the current environment?
Funding in the mining space is one of those things that I'm trying to dedicate my life to. It's like a boyfriend that doesn't want me, but I keep chasing. The love is unrequited. I'm constantly trying to find new ways to say to banks, to say to DFIs, to say to the global community, look, let's do things differently. Unfortunately, bankers don't speak mining and miners don't speak bank. And to get the two to speak the same language is an exercise on its own. I mean, I find myself constantly having to do the splits on this one. But what I have found, especially in the pursuit of trying to get funding for junior miners and emerging miners, is that there's other instruments that we can play with as opposed to straight cash. Unfortunately, we're not very innovative in that space when it comes to how we try to finance. We always think cash, cash, cash. And I think that to a very large extent, cash is never really necessary if you want your mining project to come to life. Cash is for people who want to hide their investment somewhere. For those of us who understand that junior mining can actually be done on a shoestring budget, we really don't need much cash at all. We understand that we can talk to our off-takers, and our off-takers can say, I'll give you prepayment for my first six, for the first 6 batches of material that you're able to mine for me. We have off-takers who are able to say to us, look, we're quite happy to give you a prepayment as long as you afford a royalty to our partners, a 2% royalty to our partners. There's instruments that can be utilized. Unfortunately, when a bank says we are able to give you this green incentive, they are working from a place of misunderstanding when it comes to the mining economy. It's going to take a while for South African mines to become carbon neutral. So those are not incentives that are necessarily relevant in our current space. Throughout Africa, absolutely, because the majority of African countries who have started to develop their own off-grid solutions like solar power and wind power are able to take advantage of those incentives. However, in South Africa, we have power problems. And while the minister did say we can produce our own power, how long is that going to take? What banks should be doing is saying we can develop alternative solutions for you that won't compromise your cash flow, that won't criticize your credit, because unfortunately our NCR is also it's impeding our ability to develop a lot of these projects, because people say, how are you going to pay 100 million rand back? And I'm like, I'm not going to pay 100 million rand back. The mine's going to pay 100 million rand back. There's mechanisms that we can utilize so that if that 100 million is available, then make sure you send it to the relevant parties who can actually bring the project to life. The mine can then pay for itself. We also have a group of people in mining that I like to call pseudo entrepreneurs, people who don't understand that mining is a long game. They think that mining is something that just happens overnight, then you have a Maserati and you can drive it around. Most mining projects take from 18 months to 10 years to come to life. If you don't have that kind of patience, you shouldn't be in the industry. Bankers don't know that. Bankers will say to you, what do you mean I'm only going to start making my money 10 years from now? But that's also because they don't understand the nature of the beast. So we have to develop a language where miners and bankers can become mutually intelligible one to the other, so that we actually have a clear and strategic flow of funds from those who have to those who need. What I think would be brilliant would be if the big mining companies, for their own productivity, were to invest in the junior miners. And for example, there's a lot of small chrome producers in the Northwest area that could easily supply the big chrome producers, and they can have that relationship and they can then catalyze those operations among themselves. We have to be a community that understands one another's struggles and that is able to overcome the holistic struggle of the industry by utilizing one another's resources. Without that, I think that the more we go to banks, the more frustrated we're going to get. I've had people that clients of mine who have said, but we've been to a bank, banks won't even look at our proposal. And I'm like, yeah, that's because they don't speak mining. The only people who speak mining are other miners. And if miners want money in mining, they have to put it in there themselves.
Olebogeng, on that not so happy note, I really want to thank you, to thank Mark and to thank Bruce for your participation this morning. I think it's definitely been a conversation full of energy and a conversation full of insight. And hopefully one that gets our audience thinking and ready for the next keynote speaker. So thank you very much, guys.
Thank you, Sandra. Thank you.
Thanks for the opportunity.